In a new essay, Minneapolis Fed President Kashkari says he sees 2 more rate cuts coming from the central bank this year. Steve Leisman joins us now with Mr. Kashkari. Hey, Steve, and hey, Neil.
Good morning.
Thank you, Joe. Let's bring in Mr. Kashkari, president of the Minneapolis Fed. Neil, let's talk about your essay this morning, which is fascinating. And I just want to ask you first about one of the things that you say in your piece, which is that you're concerned that there could be some erosion of the belief in the Fed's commitment to the 2% target. How much should we worry that you guys are cutting rates while you're away from your target? And not only that, don't forecast you hit your target until 2028.
Well, Steve, I don't see the erosion yet. Thankfully, it's not there in the data, but it's something that we need to work extra hard to explain to the public why we're making the actions that we're making, why we're cutting rates right now in light of the elevated inflation that we've all been experiencing for 4 years. So I identified it in my essay as a risk that what could cause inflation expectations to rise if people believe that what we call our reaction function has changed and that we would somehow be okay with 3% inflation. We're not okay with 3% inflation. I'm confident that we are going to get inflation back down to 2%, but these tariffs have pushed inflation back up, and we're having to adjust policy to try to accommodate and keep the labor market strong at the same time.
So, Neil, the old saw is watch what they do, not what they say. What are you doing about bringing inflation back down?
Well, if we look at the underlying components, and I don't get into this as much into my essay, housing services inflation is on a very steady trajectory to come down. I've got a lot of confidence that housing inflation is going to continue to come down. Non-housing services inflation is slowly coming down. It's pretty tied to wage growth, and wages are on a downward trajectory. So I've got pretty good confidence that those two segments are going to continue to come down. The core goods inflation had actually ticked negative at the start of this year. That was very good news. It had been negative before the pandemic. They've now come up because of tariffs. And so it really comes down to, do you believe tariffs are a one-time effect or something more persistent? I'm getting more confident that it's more likely a one-time effect, but it's going to take a couple of years for it to play out.
Another thing you talk about in your essay is the concern that the erosion of Fed independence could lift inflation expectations. I get that concept theoretically, but you don't really see it in the bond market. What's the source of that concern, and why do you think the bond market doesn't seem to care about it?
Well, I talked to a lot of market participants. I talked to folks up on Capitol Hill on both sides of the aisle. I think there's widespread appreciation for how important Fed independence is, both to keeping inflation expectations low and anchored, as also to defending the dollar. Those two things are tightly related. But I also think there's a lot of confidence on both sides of the aisle that Fed independence is important and will be protected, and that the courts also see it that way. You can see the Supreme Court's ruling a couple months ago defending Fed independence. So I think people are betting on the institutions of the country continuing to keep Fed independence, to keep it outside of the short-term political process. And certainly, I think we all want the same.
Neil, couldn't you argue that a cut in rates, a quarter point rate, I mean, if you connect the dots to, okay, you know, money's cheaper, people are going to do more, that's going to cause the economy to heat up. I mean, way down the line, way down the road, maybe it's inflationary. But at face value, why doesn't it make certain things cheaper when interest rates go down? Why couldn't you say it actually might help inflation? And people have started to say that, haven't they, Leisman?
Well, I've heard those arguments, Joe. But if you look at mortgage rates as an example, there's a lot of different things that go into mortgage rates. I wrote in my essay that I think the neutral rate of interest has actually gone up. And if you look at over the past year, the FOMC has cut rates by more than 100 basis points. The long end of the curve has been pretty unresponsive to our short-term policy moves. That tells me it's possible that the neutral rate has gone up. And so it's possible that we cut the short end a little bit over the course of the next 6 months or a year, and it ends up not translating into much movement down on mortgage rates. So I don't think it's one for one that a cut in mortgage rates is going to make things immediately cheaper.
Right. There's other interest rate sensitive factors where it could be. And it's happened again. I mean, it's only 10 basis points, but ever since you cut, the 10-year has actually ticked higher with just barely with the yield. But no one, and including, I don't think, on the Fed, is anyone complaining about 4.1 on the 10-year after all the worries about, our status in the world and the reserve status. I mean, I would sign on for 4.13. Things are going great in the bond. Things are quiet. The vigilantes are, they're not making a peep with $38 trillion in debt.
Well, yeah, I do write about that in the essay, what the disconnect is from the signals that we're getting from the labor market, which is showing a slowdown. Wage growth, payroll employment, for example, all of those are pointing in one direction, and yet financial markets seem quite exuberant, whether it's the stock market or the bond market. Credit spreads are very low. Meme stocks are back. Those are more signals that tell me, hey, wait a second, maybe policy is not all that tight. Nonetheless, I do take seriously half of our dual mandate that the labor market is showing signs of weakening. And so I wrote in my piece that I thought it was appropriate to cut. But I'm not sure how many more cuts we have to get to before we get back to something that looks like neutral.
Neil, I have an almost personal question, being in the room, if you will. And I think everyone's always curious about independence and politics. And I know you've said repeatedly that politics don't enter these conversations. But with Steve Moran in the room, given his role at the White House and in this temporary role now, and being the outlier also in the room in terms of what he wanted to do with interest rates. Did politics enter that conversation?
It really didn't. The FOMC has 19 participants, and every year there's always some turnover with presidents retiring or governors retiring and new people coming in. And this was like any other transition where somebody comes in and everybody says, hey, welcome to the table. We look forward to hearing your contributions. And then everybody went about their business as normal. And so what was remarkable about this meeting is how unremarkable it was. And then obviously the chairman achieved a tremendous consensus, not perfect consensus, but tremendous consensus at the end of the day, which I think is a credit to him.